You can lose 10 years of your life, not because you are poor, but because you chose the wrong asset for the kind of person you actually are. I want you to imagine this. You are 24 years old. You have $8,000 in your account. Not lucky money, not money from your parents, not money that fell into your life from some magical opportunity. That money is 14 months of cooking at home instead of going out. 14 months of saying no to trips while your friends posted photos online. 14 months of looking at something you wanted and telling yourself, not yet. And now, that $8,000 is sitting in a bank account, barely earning anything. Every month that passes, inflation takes a small bite, quietly, without drama, without blood, but with absolute certainty. You know you cannot let that money sit there forever. And in front of you are two doors. The first door is the stock market, a brokerage account, an index fund, a market your parents once called gambling, until someone they knew got rich from it, and suddenly everyone started calling it investing. The second door is real estate, a house, a mortgage, a physical asset you can drive to, touch with your hands, look at the walls, look at the roof, look at the front door, and tell yourself, this is mine. But here is what most people tell you wrong. The real question is not whether stocks or real estate make more money. The real question is this: which kind of pain can you live with longer? Stocks will not call you at midnight, but they will make you watch your account drop 20% and ask whether you are calm enough not to destroy your own future. Real estate will give you the feeling of owning something real, but it can also hand you a broken air conditioner in the hottest month of the year, a tenant who pays late, a roof that needs repair, and a bill your original spreadsheet was too innocent to see coming. This video is called Choose the Wrong Asset, Lose 10 Years. You are not watching the wrong video. This is not a video telling you that stocks are better than real estate, and it is not a video worshiping property, as if buying a house automatically makes you rich. I made this video because too many young people are asking the wrong question. They ask, which one makes more money? But they do not ask, which one fits the way I live? They do not ask, which one fits my nervous system? They do not ask, can I survive a red market screen? Or can I survive an 11 p.m. call about a plumbing problem? And when someone chooses an asset that does not fit who they are, they do not only lose money, they lose rhythm, they lose calm, they lose career opportunities. They lose 5 years, 7 years, sometimes even 10 years, trying to crawl back to the place where they could have been much further ahead. I do not want you to be afraid of investing. I want you to be awake before you invest. Because assets do not only make you richer, assets train you. Stocks train you to sit still while the whole world is screaming. Real estate trains you to get up and solve problems when all you want to do is sleep. One demands patience. The other demands operational skill. One gives you flexibility. The other gives you leverage. One is lighter on your calendar. The other is heavier on your shoulders, but it can build wealth faster if you do it right. In the next few minutes, I will take you through two different lives. One person chooses stocks first. One person chooses real estate first. Both begin with $8,000. Both want to become wealthy. But by age 35, what is different is not just the amount of money in their accounts. What is different is the person they have become. So listen carefully, because you may think you are only choosing an investment. But the truth is, you are choosing the kind of pressure you will live with for the next 10 years. Your first $8,000 does not decide whether you become rich. It decides which kind of pain you can tolerate. Your first real savings is not money. It is a mirror. And if you look closely enough, it will show you the kind of investor you are capable of becoming. You are 24 years old. You have $8,000 saved. To someone already wealthy, that may not sound like much. But to a young person who earned it slowly, $8,000 is not a small number. It is packed lunches. It is skipped weekends. It is saying no when everyone else said yes. It is walking past things you wanted and telling yourself, not yet. That money is not just sitting in your account. It is holding 14 months of discipline. And that is why the next decision feels so heavy. Because when you only have a little, every choice feels permanent. You look at the stock market, and it feels invisible. Numbers on a screen. Green today, red tomorrow. People online saying buy. Other people saying crash. Your parents calling it gambling. until someone they know made money, and suddenly it became investing. Then you look at real estate, and it feels real. A house, a door, a roof, a mortgage. Something you can touch, something your uncle swears by at every family dinner. He says, land never goes to zero, but he forgets to mention leaking pipes, late tenants, insurance bills, property taxes, and the kind of stress that does not fit inside a motivational quote. So you ask the question everyone asks, which one makes more money? But that is the wrong question. The better question is this: which one can I stay with when it becomes painful? Because every asset class collects payment from you, not always in dollars, sometimes in patience, sometimes in sleep, sometimes in freedom, sometimes in your weekends, sometimes in your nervous system. The stock market charges you emotionally. It makes you watch your money fall while doing absolutely nothing wrong. It teaches you that a good decision can look stupid for months, sometimes years. You can buy a strong index fund, do everything correctly, and still open your account to see red. That is the pain of stocks. You suffer by doing nothing. Real estate charges you operationally. It makes you answer calls, compare contractors, read inspection reports, negotiate with lenders, handle vacancies, and learn that cash flow on paper is not the same as cash flow in real life. That is the pain of real estate. You suffer by being responsible. Neither path is easy. They are simply difficult in different languages. And this is where many young investors make their first expensive mistake. They choose the asset that looks impressive instead of the asset that matches their temperament. A quiet, patient person who hates dealing with people may buy rental property because social media told them it is the fastest path to wealth. Then they discover they do not hate real estate returns. They hate real estate life. An energetic, hands-on person who wants control may put everything into index funds, then go crazy because there is nothing to fix, nothing to negotiate, nothing to improve. They do not hate stocks. They hate waiting. That is why your first $8,000 matters so much. Not because it will make you rich by itself. It will not, but because it starts training you. If you put it into stocks, you are training the muscle of patience. You are learning to contribute, ignore noise, survive volatility, and let time do what your ego cannot. If you put it toward real estate, you are training the muscle of operation. You are learning financing, repairs, risk, negotiation, tenants, cash reserves, and the uncomfortable truth that ownership always comes with responsibility. Both muscles can build wealth, but they build different people. And before you rush through either door, I want you to understand one more thing. Do not invest your last dollar just because you are afraid of missing out. A person with $8,000 and no emergency buffer is not investing from strength. They are gambling with their oxygen. Keep a cushion, even a small one, because the market can fall at the wrong time. A car can break at the wrong time. A medical bill can arrive at the wrong time. And if you are forced to sell your investment during a bad month, the problem was not the asset. The problem was that you had no margin. Margin is what keeps a temporary problem from becoming a permanent mistake. So at this first stage, your goal is not to look sophisticated. Your goal is to become unbreakable enough to stay in the game. Because the investor who survives usually beats the investor who only sounds smart. The lesson of this chapter is simple. Your first investment is not really about returns. It is about self-knowledge. Can you sit still while the market bleeds? Can you answer the phone when the property breaks? Can you follow a boring plan when your friends are chasing fast money? Can you choose the pressure you can live with, not the fantasy that looks best online? That is the real fork in the road. Not stocks versus real estate. Patience versus operation. Liquidity versus leverage. Freedom versus control. A quiet machine versus a physical business. And now that you understand the first rule, we can walk through the first door. The stock market. The place where you can build wealth without fixing a single toilet, but only if you can survive the most difficult command in modern finance. Do nothing. Stocks do not teach you to get rich fast. They teach you to sit still when the screen is red. The stock market looks easy from the outside. That is the trap. You open an app. You transfer money. You buy an index fund. No banker shakes your hand. No contractor walks through the house. No tenant signs a lease. No one gives you a key. You click confirm, and suddenly, you own a tiny piece of thousands of companies. It feels too simple to matter. But do not confuse simple with easy. At 24, you take your first $8,000 and put it into a total market index fund. You keep $500 in cash because you remember what it feels like to be broke, and you are not foolish enough to invest every drop of oxygen you have. You expect something to happen. Maybe pride, maybe excitement, maybe the feeling that your future has finally started. But nothing dramatic happens. The screen changes. A number appears. And 2 days later, the market is down. Your account is smaller than when you started. That is the first lesson stocks teach you. A good decision can feel bad immediately. This is where new investors become confused. They think if they made the right move, the account should reward them quickly. But the market is not your parent. It does not clap when you behave. It does not comfort you when you are scared. It does not explain itself. It simply moves. 1 week later, your account is down 4%, then 7%, then 11%. You watch hundreds of dollars disappear, not loudly, not with a crash, but quietly, one red day at a time. And now the real investment begins. Not the money. The psychology. You start checking the account every morning, then during lunch, then before bed. You read articles. That is usually a mistake. One expert says, the market is entering a new golden age. Another says a recession is coming. One chart says, buy. Another chart says, wait. Everyone sounds confident. Nobody is responsible for your future. So there you are, 24 years old, staring at a red screen, trying to decide whether patience is wisdom or stupidity. This is the emotional tax of stocks. There is nothing to fix, nothing to renovate, nothing to negotiate. Your only job is to not sabotage yourself. And for many people, that is harder than working, because the human brain hates uncertainty. It would rather do the wrong thing than sit quietly with the right thing. So you learn the first rule of the stock path. Do not turn your long-term plan into a daily emotional vote. If you bought an index fund for the next 10, 20, or 30 years, then today's red screen is not a verdict. It is noise. Painful noise, yes, but still noise. Months pass. You add money when you can. $400 some months. $200 other months. Nothing. During the month, your car needs repair. The market does not judge you. It accepts what you give it. That is one of the quiet gifts of stocks. They allow imperfection. You can be young, you can be busy, you can be building your career, you can be moving apartments, changing jobs, learning skills, making mistakes, and still invest in small pieces. No tenant calls, no roof leaks, no city inspection, no property tax bill arriving when your life is already stretched. The portfolio asks very little from your calendar, but it asks a lot from your character, because boredom becomes the second enemy. After the fear fades, the boredom arrives. You check the account, and nothing meaningful has changed. You contribute again. Nothing changes. You wait, still nothing dramatic. And then your brain starts whispering, maybe I should do something smarter. Maybe I should pick individual stocks. Maybe I should time the market. Maybe I should move everything into whatever is hot this year. This is where many investors ruin a beautiful plan by trying to improve it. They confuse activity with intelligence. But in index investing, most of the time, the intelligent move is no move. That sounds easy. It is not. It means watching other people brag about quick wins while you keep feeding a boring machine. It means accepting that wealth can grow quietly while your life looks exactly the same. It means understanding that the market rewards ownership over time, not excitement on demand. By 30, if you stayed consistent, something strange happens. The account is no longer small. Maybe it is $60,000, maybe $70,000, maybe more if your income grew and you increased your contributions before lifestyle inflation swallowed the raise. And the strangest part is this. You do not remember one heroic moment that built it, because there was no heroic moment. There were only repeated ordinary decisions. Buy, hold, od, ignore, repeat. That is the stock market path. It is not dramatic, It is not cinematic. It does not make you feel powerful every week. But it gives you something deeply valuable in your 20s. Flexibility. You can move cities for a better job. You can switch careers. You can take an opportunity without worrying about a rental property across town. Your money is liquid. Your weekends are yours. Your investment does not ask you to become a part-time manager. But the cost of that freedom is patience. You do not control the market. You cannot force appreciation. You cannot renovate the S&P 500. You cannot call the economy and demand better performance. You are a passenger in a very powerful machine. Your job is to stay on board. So, the lesson of this chapter is simple. Stocks are not a test of whether you can predict the future. They are a test of whether you can keep your hands off a good decision while the future unfolds. And if you can do that, the stock market can become one of the cleanest wealth-building machines available to a young person. But not everyone wants a quiet machine. Some people want control. They want something they can touch, improve, finance, negotiate, and force upward with their own hands. That is the second door. Real estate. Real estate is not just a physical asset. It is the phone call at midnight. Real estate looks powerful because you can touch it. That is also the trap. A stock is a number on a screen. A house is a door, a roof, a kitchen, a street, a set of keys in your hand. It feels more real, more serious, more adult. And for many people, that feeling becomes dangerous because they confuse physical with safe. At 24, your $8,000 does not buy real estate. It only starts the conversation. So you save harder. You skip more dinners. You work weekends. You become a little less fun to be around because now every dollar has a job. By 25, maybe you have $31,000 saved. Enough to start looking seriously. You find a small duplex in a neighborhood that is not beautiful yet, but not hopeless either. The numbers almost work. One unit can be rented. You can live in the other. The bank is willing to lend. The down payment is possible. And suddenly, the idea becomes real. You sign the papers. You get the keys. And for one beautiful moment, you feel like you have crossed into adulthood. Then, the first problem arrives. Maybe the tenant is late. Maybe the air conditioner breaks. Maybe a pipe leaks. Maybe the roof has a problem the inspection report described too gently. And that is when real estate teaches you its first lesson. Ownership does not end when you buy the asset. Ownership begins when the asset starts asking things from you. This is the part social media often hides. They show the closing photo. They show the cash flow number. They show the house before and after renovation. They do not show you standing in a hardware store at 8:40 p.m., trying to understand which part fixes a leaking faucet while your dinner gets cold and your bank account feels too thin. They do not show you the first time a tenant calls and says something is wrong. They do not show you the feeling of realizing that the problem is not theoretical anymore. It is yours. That is the difference between stocks and real estate. When your index fund drops, it hurts your emotions. When your property breaks, it demands your action. Real estate is not passive at the beginning. It is active ownership. Even if the cash flow looks passive on paper, your attention is still part of the business. You have to learn. You learn what a plumber costs. You learn what a bad contractor sounds like. You learn that cheap repairs can become expensive repairs later. You learn that a good tenant is worth more than a slightly higher rent from a risky one. You learn that vacancy is not empty space. Vacancy is money leaving your life every day with no one living there. You also learn that a spreadsheet can be honest and still incomplete. On paper, the property may cash flow $300 a month, but real life does not arrive in smooth monthly averages. One month is quiet. Another month gives you a $2,800 repair. Then the next 9 months are not profit. They are recovery. This is why cash reserves matter so much in real estate. Your reserve is not extra money. It is oxygen for the property. Without it, one broken system can force you into credit card debt, panic, or a bad sale. And that is where beginners get hurt. They buy the property, but they do not fund the business. A rental property is not just an investment. It is a small company with walls. It has income. It has expenses. It has customers. It has maintenance. It has risk. And if you treat it like a magic wealth machine, it will humble you quickly. But I do not say this to scare you away, because real estate also teaches something powerful. It teaches responsibility in a way few investments can. At 26, if you survive the first year, you know more than you did before. Not because you read a book, because the asset trained you. You understand cash flow differently. You understand debt differently. You understand negotiation differently. You understand that wealth is not just owning something valuable. It is keeping that valuable thing alive long enough for time, debt paydown, rent growth, and appreciation to work in your favor. And then, one day, the first rental deposit hits your account. Maybe it is not huge. Maybe after all expenses, the property produces only $300 a month. But that $300 feels different from a paycheck. You did not clock hours for it. You built a system that produced it. And that changes how you see money. You begin to understand why people love real estate. Not because it is easy, because it has levers. You can improve the property. You can negotiate the purchase price. You can refinance. You can raise rents responsibly when the market supports it. You can use debt to control a larger asset than your cash could buy alone. You are not just waiting for the market. You are operating inside the asset. That control is intoxicating. But control has a cost. Your weekends are not always yours. Your location matters. Your phone matters. Your decisions matter. And sometimes, your tenant's problem becomes your problem at the worst possible hour. That is the real estate path. It gives you a physical asset, but it asks for physical responsibility. It gives you leverage, but it demands reserves. It gives you control, but it takes attention. So the lesson of this chapter is simple. Do not buy real estate because you want passive income. Buy real estate only if you are willing to become the kind of person who can manage responsibility before it becomes wealth. Because a property is not just a building. It is a test of your patience, a test of your cash reserves, a test of your judgment, a test of whether you can stay calm when ownership becomes inconvenient. And if you can pass that test, real estate can become one of the strongest wealth-building machines available. But if you misunderstand the machine, it can turn one small mistake into a very expensive lesson. That is why we have to talk about the engine that makes real estate so powerful and so dangerous. Leverage. Leverage can make you rich faster, but it also magnifies every mistake. Leverage is the reason real estate looks like magic. It is also the reason real estate can become dangerous. Because leverage lets you control an asset you did not fully pay for. You may put down $30,000, but control a $250,000 property. The bank funds most of the purchase. You own the upside. The tenant helps pay the debt. And if the property rises in value, the gain is calculated on the whole property, not just your down payment. That is powerful. But power is never free. Let me make it simple. If you buy a $250,000 property with $30,000 down, and the property rises 5%, the property gained $12,500 in value. On the surface, 5% does not sound dramatic, but compared to your $30,000 of cash invested, that $12,500 is a much larger return. That is leverage. The asset moves a little. Your equity can move a lot. This is why real estate can build wealth faster than people expect. You are not only using your money, you are using the bank's money. You are using time. You are using rent. You are using inflation. You are using debt paydown. All of these forces can work together. But here is the harsh truth. The same leverage that multiplies your gains can also multiply your pain. If the property value falls, your equity falls faster than the property. If rent stops coming in, the mortgage still wants to be paid. If the air conditioner breaks, the bank does not care. If the tenant leaves, the insurance bill still arrives. If taxes rise, the payment does not wait for your mood to improve. Debt does not sleep. Debt does not feel bad for you. Debt does not say, take a month off. That is why leverage is not evil, but it is unforgiving. A stock investor can be wrong and simply watch the account fall. A real estate investor can be wrong and still owe the bank every month. That difference matters, because in stocks, volatility attacks your emotions. In leveraged real estate, volatility attacks your cash flow. And cash flow is oxygen. Without cash flow, Even a good asset can become a bad experience. This is where beginners often fool themselves. They run the numbers in a spreadsheet. Rent comes in, mortgage goes out, insurance goes out, taxes go out, maintenance reserve is estimated, and the bottom line says positive cash flow. Maybe $300 a month. It looks safe, but then real life arrives. 1 month of vacancy, a $1,200 repair, a tenant who pays late, a city inspection, a higher insurance premium. Suddenly, that $300 monthly cash flow looks very small. Because real estate does not fail in averages. It fails in timing. The property may be profitable over a full year, but if the wrong expenses arrive before the right income, you are the bridge. And if you do not have reserves, you become the weakest part of the investment. That is why reserves are not optional. They are not lazy money. They are not money doing nothing. They are what allows leverage to stay useful instead of turning violent. A cash reserve is the shock absorber between you and a forced mistake. Without reserves, you may sell at the wrong time, borrow at the wrong rate, use credit cards for repairs, panic when a calm investor would simply pay the bill and continue. Leverage rewards the prepared and punishes the romantic. The romantic says, "The tenant will pay my mortgage." The prepared investor says, "What happens if the tenant does not pay for 3 months?" The romantic says, "The property will appreciate." The prepared investor says, "Can I survive if it does not?" The romantic says, "I can refinance later." The prepared investor says, "What if rates are higher when I need to refinance?" That is the difference between using leverage and being used by leverage. Now compare this to stocks. Stocks usually do not give a young investor that kind of leverage. You buy what you can afford, you add more over time. It feels slower because it is cleaner. No tenant is helping you buy more of the S&P 500. No bank is funding 80% of your index fund. No one is paying down your loan while the asset appreciates. That is why real estate can pull ahead on paper. It has more engines, but more engines also mean more ways to break. And this is the central trade-off. Stocks give you simplicity. Real estate gives you machinery. Simplicity is slower, but lighter. Machinery is faster, but heavier. If you are going to use leverage, you must respect it. Do not borrow to look rich. Do not assume appreciation will save bad math. Do not count every dollar of rent as profit. Do not buy without reserves. Do not treat debt like a toy just because the bank approved you. A bank approval does not mean the deal is good. It only means the bank believes it can get paid. Those are not the same thing. The lesson of this chapter is simple. Leverage is not a shortcut. It is an amplifier. It amplifies your discipline. It amplifies your preparation. It amplifies your skill. But it also amplifies your ignorance, your impatience, and your optimism. Used wisely, leverage can help you control assets that grow faster than your savings alone. Used carelessly, it can turn one bad year into a financial wound that takes years to heal. So before you envy the real estate investor who controls hundreds of thousands of dollars in property, ask the real question. Can they survive the debt when the story stops being pretty? Because the winner is not the person with the biggest loan. The winner is the person whose system can survive pressure. And that brings us to the final chapter. By age 35, the question is no longer which asset looked better at 24. The question is which kind of pressure you were able to carry for 10 years without quitting. By age 35, the winner is not the person who chose the best asset. It is the person who stayed with the right pressure. By age 35, the question changes. At 24, you ask, should I buy stocks or real estate? At 35, life asks a colder question. Did you stay? Because wealth does not usually come from the asset you choose on your best day. It comes from the asset you can hold through your worst months. Let us look at the two versions of your life. In the first version, you chose stocks. You opened the brokerage account. You bought the index fund. You watched the market fall, recover, rise, fall again, and rise again. You did not feel rich most of the time. That is the strange thing about the stock path. It builds quietly. There are no keys in your hand, no tenant paying you rent, no building you can point to and say, that is mine. Just a number on a screen that slowly becomes harder to ignore. By 35, If you stayed consistent, your account may be $140,000, maybe $180,000, maybe more if your income grew and you raised your contributions before your lifestyle swallowed the money. But the real gain is not only the portfolio, it is the life around the portfolio. You were flexible. You moved cities for a better job. You said yes to a career opportunity because no property tied you to one neighborhood. Your weekends were yours. Your attention was mostly yours. Your investment did not call you. It did not leak. It did not ask for a contractor. It did not require you to negotiate with a tenant on a Friday night. The stock path gave you a quiet machine, but it asked for one very difficult thing: emotional endurance. You had to watch red screens without panicking. You had to keep buying when the headlines sounded terrifying. You had to accept boredom without trying to be clever. You had to let time do its work while your ego begged for action. That is not easy. Do not let anyone tell you it is easy. Sitting still for 10 years is not laziness. When the world is screaming, sitting still can be discipline. Now look at the second version. You chose real estate. At 25, you bought the first property. You were excited, terrified, and undercapitalized in ways you did not fully understand yet. Then, reality trained you. The tenant paid late. The repair was bigger than expected. The insurance bill rose. The vacancy hurt more than your spreadsheet predicted. You learned that owning property is not just owning an asset. It is managing a small operating system. But you stayed. You built reserves. You learned to screen tenants. You learned the difference between a cheap contractor and a good one. You learned that cash flow is not what happens in a perfect month. Cash flow is what survives a bad year. By 35, maybe you own 2 or 3 properties. Maybe your equity is $280,000, maybe $350,000. Maybe your properties produce $1,400 a month in cash flow after expenses. On paper, you may be ahead of the stock investor, but paper does not show everything. It does not show the weekends you gave up. It does not show the stress you carried. It does not show the nights you answered a call when you wanted to sleep. It does not show the mental space taken by roofs, leases, taxes, repairs, and debt. Real estate gave you more levers, but every lever came with responsibility. You could force appreciation. You could refinance. You could negotiate. You could improve the asset, but you also had more ways to make expensive mistakes. And that is the true difference. Stocks give you fewer levers and fewer interruptions. Real estate gives you more levers and more responsibility. Neither is morally superior. Neither is automatically smarter. They are different machines for different people. And this is where many people get the whole conversation wrong. They ask which path creates more wealth, but they forget to ask which path they can actually sustain. A person who hates uncertainty may not survive stock market volatility. A person who hates operational problems may not survive real estate. A person who needs freedom may feel trapped by property. A person who needs control may feel helpless in index funds. The right investment is not only the one with the best historical return, it is the one you can keep feeding when life becomes inconvenient, because both paths punish casual people. Stocks punish the person who sells during the first serious correction. Real estate punishes the person who buys without reserves and panics when the first major repair arrives. Both paths reward commitment. Both paths punish fantasy. So, here is the lesson I want you to carry. Do not choose the asset that looks richest on social media. Choose the asset whose pain you respect. If you choose stocks, respect volatility. Respect boredom. Respect the fact that your main job is not to outsmart the market, but to stop yourself from interrupting compounding. If you choose real estate, respect debt. Respect repairs. Respectons. Respect the fact that property is not passive in the beginning. It is a business with walls. And remember this. By 35, the winner is not the person who looked the smartest at 24. The winner is the person who built a system they did not abandon. Because time does not reward the most excited beginner. Time rewards the person who can continue. So before you choose your first door, ask yourself honestly, can I stay calm when my portfolio falls? Can I stay responsible when my property breaks? Can I build for 10 years without needing the path to flatter me every month? That is the real test. The money is only the scoreboard. The asset is only the vehicle. The driver is you. And if you choose the path that matches your temperament, your cash flow, your patience, and your life, you do not just build a better portfolio. You build a version of yourself that can actually hold wealth when it arrives. Invest as early as you can. Invest as consistently as you can. And please remember this, my friends. Wealth is rarely built by one perfect decision. It is built by small, disciplined decisions, repeated again and again, while the rest of the world is distracted. I hope that one day, years from now, you will call me and say, I became a millionaire because one 40-minute video changed the way I saw money. And if that day comes, I want you to understand something. It was never really the video that made you rich. It was you. You listened. You stayed disciplined. You respected time. You respected cash flow. You respected the quiet power of investing before the world forced you to care. So, start early, stay consistent, and let time become your greatest financial partner.